Good day, guys. All right. So, in this video, we'll be talking about forest terminologies and what these terminologies are all about. So, the first one we'll be looking at is PIPs, so PIP, PIPs. So, these PIPs actually has to do with the definition of PIPs is the smallest but price movement in a currency what a currency pair. So, PIPs is actually used to measure the movement in the market and it's usually used to calculate your profit. So the formula of this is what profit in what in percent. So if you are trading financial market, you end up seeing this movement. So now let me give us an example of the pip. So now this is at this point, this very point, you did notice that we have a figure being read out here. We have 1.08430. So now moving upward rather, then we have 1.08409. So all you just have to do is to subtract the figure at the down away, the last two figures at the down away from what the two figures upward, and you'll be able to get what the movement in percent. From their region you entered to the region you exited what you trade. So let's say for instance you are entering a trade here, then from this very point the market moves. Now this point is what 1.8030. The market moves up to this very point, that is a buy market. You eventually exit the trade at 1.08448. So there's a tendency after calculating you should be able to what to get your profit. You should be able to what to get your profit. There is a more easier way in calculating this. Now you can still hold your stuff, then take it upward, then you should be able to what to get your percentage in what in profit. So all you just have to do is to use 0.00122 to times what the lot size which you use in entering what which you use in entering that trade. So that is for pips. So now the next um terminology we'll be looking at is your lot size. So it's very, very important whenever as a forex trader, whenever you are trading, it's very, very important to take into account the lot size which you are using towards to go into what the trade to avoid what making unnecessary what losses. So the whole essence of your lot size is to help you to maximize what profit and minimize your losses. So now whenever you want to enter a trade, this is a demo account of mine which I just opened recently. So just a moment. So let's assume I want to place a trade. So the first thing I do, I believe we already are aware how to where the icon for placing trade is. Hold on. Okay. So this is my this is basically my this is basically where you can enter a trade. So okay, now let me go to a more better currency. Let me enter this currency pair. Okay, okay, okay. So this is my lot size. This very point here is my lot size. So whenever I want to enter a trade, what I just have to do is to reduce it to the lowest lot size. So for instance, if I want to enter a buy trade or a sell trade, all I just have to do is to reduce it. Use the lot size. So let's assume I have an account of $10 and then I used $1 to enter a trade. It's possible. But when the market moves a very short distance, your $10 will disappear. But then if I'm using 0.0.01, which is the lowest, because 0.01 is the lowest. If you notice, this very reduced icon is not present. But if you want to increase, it's possible. You can increase, but 0.01 is the lowest value you can reduce to. So now let's assume I enter a trade and I enter with a lot size that is way higher, or should I say that will incur on me more losses, and I will end up on my account. So that's why most traders they often crash out of the market. Why? Because they often enter the market with high lot size. and they end up what doing their time. So the next one we're looking at is your leverage. So your leverage is more or like your borrowed what your borrowed capital to increase your trading what position. So now your leverage is determined by the broker which you are using. So your leverage basically is it enables you to enter trade in multiple world positions. So for instance, if you are we have so many leverages, we have 1 to 100, 1 to 200, 1 to 1,000, 1 to 2,000. So depending on the broker you are using, so the broker you are using will determine the broker you are using will determine what the will determine the leverage which you'll be given. So it's still very important that you choose a good broker. So the next thing we'll be looking at is the margin. So the margin is the required fund that is expected, that is needed rather to open up a trading what position. So your margin, whenever you enter a trade, your margin it will your margin will be counting as well. So it will get to a point, if you are incurring more losses, there will be a signal telling you that this is the amount of space, this is the amount of units that is remaining for you before this account get closed out. You get, so that is just your margin. So your margin is more like a signaling what factor that tells you how the market is and what to do in the market as regarding to your fund. So now next thing we'll be looking at is your currency pair. So your currency pair being traded in the forex market just has to do with these pairs I've shown you already. So in the currency pair, we have two currencies that are actually involved. Now, basically, these terms I've been explaining are basically being seen in the financial market. So currency pair basically has to do with two currencies that is being traded against each other. For instance, we have your Euro USD and so on and so forth. We have your New Zealand USD, we have your Australia USD, we have your USD Japanese yen, and so on and so forth. So the next thing we'll be looking at is the bid what price. So the bid price is the price at which you have to buy what a currency. While the ask price is the price at which you have to sell a currency. Now we have what we call spread. Spread is basically the difference between what the bid and the ask what price. So spread is just the basic what difference between what the bid price and what and the ask price. Now there is a term called long and there is a term called short for it. So whenever I tell you to go long, what I'm asking you to do is to what to buy a currency expecting the market to go in a bullish what direction. That will also make you to ask the question, what do we mean? What do I mean by when I say bullish what direction? Now we'll get to that very point. Now when I say short, if I ask you to go short, I'm asking you to what to sell a currency expecting the market to go to a bearish what direction. So now basically we have what we call bullish and bearish. So bullish is a situation whereby the market is moving in an uptrend, going in the upward direction, while bearish is a situation whereby the market is moving in a downward direction, moving in a downtrend. So now we have what we call trend. In the forex market, it basically has three trends. It has uptrend, the downtrend, and the sideways. So in forex, basically, now if you notice very well, you discover that from this very angle down to this point, you notice that the market was moving in a downtrend. Now, if you take a very good look to this point as well, you discover that the market was moving from this point from this point upwards. Discover the market was moving in an uptrend. So it was moving upward. It was giving you higher high, higher low, higher high, higher low. So I'm looking for a clear example of sideways. Sideways. From here, you can still see the market moving in a sideways direction. Okay, so let me draw so we can get a clear example of what I'm saying. Now you did notice that from this point, the market was just moving in a what in a sideways what direction. So hold on. It's very important that you have okay. So you did notice that the market was moving what in a sideways what direction. So now we have what we call resistance, support, level, and so on and so forth. These are some of the things that you can still go do more research on and get yourself acquainted. So in our next class, we'll be looking at the type of markets and how to apply these markets when trading.